Alright, continue reading of the CFA Level 1 program curriculum, study session 17, Fixed Incomes 2. This study session examines the fundamental elements underlying bond returns and risk with a specific focus on interest rates and credit risk, duration, convexity, and other key measures of assessing a bond's sensitivity to interest risk are introduced. An explanation of credit risk and the use of credit analysis for risky bonds concludes the session. Reading 54 and reading 55. These are the readings in this session. Okay. Reading 54, Understanding Fixed Income Risk and Return. Learning outcomes, the candidate should be able to calculate and interpret the sources of returns for investing in a fixed rate bond. Define, calculate, and interpret Mercoule's modified and effective durations. Explain why effective durations is the most appropriate measure of interest rate risk for bonds with embedded options. Define key rate durations and describe the use of key rate durations in measuring the sensitivity of bonds to changes in the shape of the benchmark yield curve. Explain how a bond's maturity, coupons, and yield level affects its interest rate risk. Calculate the duration of a portfolio and explain the limitations of portfolio durations. Calculate and interpret approximate convexity and distinguish between approximate and effective convexity. Estimate the percentage price change of a bond for a specified change in yield given the bond's approximate duration and convexity. Describe how the term structure of yield volatility affects the interest rate risk of a bond. Describe the relationship among a bond's holding period return, its duration, and the investment horizon. Explain how changes in credit spread and liquidity affects yield to maturity of a bond, and how the duration and convexity can be used to estimate the price effect of the changes. Excuse me. Okay, introduction. It is important for an analyst to have a well-developed understanding of the risk and return characteristics of fixed income investments beyond the vast worldwide market for publicly and privately issued fixed-rate bonds. Many financial assets and liabilities with known future cash flows may be evaluated using the same principles. The starting point for the analysis is a yield to maturity or internal rate of return on the future cash flows. Which was introduced in the fixed income valuation reading. The return on a fixed rate bond is affected by many factors, the most important of which is the receipt on the interest on principal payment in a full amount and on the scheduled dates, assuming no default. The return is also affected by changes in interest rates that affect coupon reinvestment in the price of the bond. If it is sold before it matures. Measures of the price changes can be derived from the mathematical relationship used to calculate the price of the bond. The first of these measures, duration, estimates the change in the price for a given change in interest rates. The second measure, the convexity, improves the duration estimates by taking into account the fact that the relationship between price and yield to maturity of a fixed rate bond is not linear. Section 2 uses mathematical examples to demonstrate the source of return on an investment. So this is just what the sections are talking about. We don't have to go into that. The source of return, an investor in a fixed rate bond has three sources of returns: receipt of the promised coupon on the principal payment on the scheduled date, reinvestment of coupon payments, and potential capital gains or losses on the sale of the bond prior to maturity. In this section, it is assumed that the issuer makes the coupon and principal payments as scheduled. The reading focuses primarily on interest rate risk, which affects the reinvestment of coupon payments and the market price if the bond is sold prior to maturity. Credit risk is considered in section 5 of this reading and is the primary subject of the reading, fundamentals of credit analysis. When a bond is purchased at a premium or a discount, it adds another aspect to the rate of return. Recall from the reading on fixed income valuation that a discount bond offers the investor a deficient coupon rate, or 1 below the market discount rate. The amortization of the discount in each period brings the return in line with the market discount rate, and the bond's carrying value is pooled to par for a premium bond. The coupon rate exceeds the market discount rate, and the amortization of the premium adjusts to the return to match the market discount rate. Through amortization, the bond's carrying value reaches par value at maturity. A series of examples will demonstrate the effect of change in interest rates on two investors' realized rates of returns. Interest rates are the rates at which coupon payments are reinvested, and the market discount rate at the time of purchase and at the time of sale if the bonds is not held to maturity. In example 1 and 2, interest rates are unchanged. The two investors, however, have different time horizons for holding the bond. Example 3 and 4 shows the impact of an increase in interest rates on the two investors' total return. Example 5 and 6 shows the impact of the decrease in the interest rates. In each of the 6 examples, an investor initially buys 10-year 8% annual coupon payment bonds at the price of 85.503075 per 100 par value. The bonds yield to maturity is 10.4%. Okay. So, we could see plugging into this equation to get the return of such an amount from the par value. Example 1 demonstrates that the yield to maturity at the time of purchase measures the investor's rate of return under 3 assumptions. 1, the investor holds the bond to maturity. 2, that there is no default by the issuer, and 3, the coupon interest payment are reinvested at the same rate of interest. And these assumptions are not impossible to be met, and most bond or fixed income securities, fixed income vehicles would suggest. I am drinking peach tea today. Okay, so what is example 2 talking about? Example 2, the investor's horizon yield is 10.4%. A horizon yield is the interest rate of the return between the total return and the purchase price of the bond. The horizon yield on the bond investment is the annualized holding period rate of return. Example 2 demonstrates that the realized horizon yield matches the original yield to maturity if 1, coupon payments are reinvested at the same interest rate as the original yield to maturity, and 2, the bond is sold at a price at the constant yield price trajectory, which implies that the investor does not have any capital gains or losses when the bond is sold. Capital gains arises if the bond is sold at a price above its constant yield price trajectory. Capital loss occurs if a bond is sold at a price below its constant yield price trajectory. This trajectory is based on the yield to maturity when the bond is purchased. The trajectory is shown in Exhibit 1 for 10 years, 8% annual payment bond purchased at the price of 85 per 100 par value. A point on the trajectory represents the carrying value of the bond. At the time, the carrying value is the purchase price plus the amortized amount of the discount if the bond is purchased at the price below the par value. If the bond is purchased at a price above par value, the carrying value is the purchase price minus the amortized amount of the premium. The amortized amount for each year is the change in the price between the 2 points on the trajectory. The initial price the bond is 85.503 per 100 par value. Its price is for 1 year is such an amount. Examples 3 and 4 demonstrates the impact of the investor's realized horizon yields. If interest rates go up by 100 basis points of BPS, the market discount rate on the bond increases from such an amount to such an amount. Coupon reinvestment rate goes up by 100 BPS as well. In example 3, the buy and hold investor benefits from the higher coupon reinvestment rate. The realized horizon yield is 10.7%, 30 BPS higher than the outcome in example 1. When interest rates are unchanged, there is no capital gains or loss because the bond is held until maturity. The carrying value at the maturity date is par value, the same as the redemption amount. In example 4, the second investor has a lower realized rate of return compared with the investor in example 2, in which interest rates are unchanged. The future value of the reinvested coupon payment goes up par value because of the higher interest rates, but there is a capital loss of such an amount per 100 par value. Notice that the capital loss is measured from the bond's carrying value, the point on the constant yield price trajectory, and not on the original purchase price. The bond is now sold at the price below the constant yield price trajectory. The reduction in the realized 4-year horizon yield from 10.4% to 9.67% as a result of capital loss being greater than a gain from reinvesting coupons at a higher rate. Okay. The investor in example 6, so this is example 6. You could pause the video and look at it. Okay. The investor example 6 has a capital gains of such an amount. The capital gains is measured from the carrying value, the point of the constant yield price trajectory, the gain offset, the reduction in these examples, the interest The series of examples illustrates an important point about fixed rate bonds. The investment horizon is at the heart of understanding interest rate risk and return. There are two offsetting types of interest rate risk that affects the bond investor: coupon reinvestment risk and market price risk. The future value of a reinvested coupon payment increases when interest rates go up and decreases when interest rates go down. The sales price of a bond that matures after the horizon date decreases when the interest rate goes up and increases when the rates goes down. Coupon reinvestment rates matters when the investor has a long-term horizon relative to the time to maturity of the bond. For instance, a buy and hold investor only has coupon reinvestment rate. Market price risk matters more when the investor has a short-term horizon relative to the time to maturity. For example, an investor who sells the bond before. Okay. Therefore, two investors hold the same bond can have different exposures to interest rate risk if they have different investment horizons. Interest rate risk on fixed rate bonds. This section covers two commonly used measures of interest rate risk: duration and convexity. It distinguishes between risk measures based on changes in a bond's own yield to maturity and those that affect the bond based on changes in the benchmark yield curve. Macaulay modified and approximate durations. The duration of a bond measures the sensitivity of the bond's full price to changes in the bond's yield to maturity, or more generally to changes in benchmark interest rates. Duration estimates changes in bond prices, assuming that variables other than yield to maturity or benchmark rates are held constant. Most importantly, the time to maturity is unchanged. Therefore, duration measures the instantaneous change in bond prices. The accrued interest is the same, so it is the flat price that goes up or down when the full price changes. Duration is a useful measure because it represents the approximate amount of time a bond would have to be held for the market discount rate at purchase to be realized if the single change in the interest rate. If the bond is held for a duration period, an increase from reinvesting coupons is offset by decreasing in price if interest rates increase, and a decrease in from reinvesting coupons is offset by an increase in price if interest rates decrease. There are several types of bond durations. In general, these can be divided into yield duration and curve duration. Yield duration is the sensitivity of the bond price with respect to the bond's own yield to maturity. Curve duration is the sensitivity of the bond price with respect to benchmark yield curves. The benchmark yield curve could be the government yield curve on coupon bonds, the spot curve, or the forward curve, but in practice, the government par curve is often used. Yield duration Okay, so here's what it looks like. Okay, I'm drinking a peach tea today. The sum of the weights of one. Okay. Effective duration. Another approach to assets, the interest rate risk of a bond is to estimate the percentage change in price given a change in the benchmark yield curve. For example, a government par curve. This estimate, which is very similar to the formula for estimate modified duration, is called the effective duration. The effective duration of a bond is the sensitivity of the bond's price to a change in a benchmark yield curve. The formula to calculate effective duration is equation 9. The difference between approximate modified duration and effective duration is the denominator is in the denominator. Modified duration is a yield duration statistic in that it measures interest rate risk in terms of change in a bond's own yield to maturity. Effective duration is a curve duration statistic. It is the measure interest. It measures interest rate risk in terms of a parallel shift in the benchmark yield curve. Effective duration is essential to the measurement of interest rate risk of a complex bond, such as a bond that contains an embedded call option. The duration of a callable bond is not the sensitivity of the bond price to a change in the yield to worst. The problem is that future cash flows are uncertain because they are contingent on future interest rates. The issuer's decision to call the bond depends on the ability to refinance the debt at a lower cost to fund. In brief, a callable bond does not have a well-defined internal rate of return. Therefore, yield duration statistics, such as the model of the Macaulay duration, do not apply. Effective durations is the appropriate duration measure. The specific option pricing model that are used to produce the inputs to effective duration for a callable bond are covered in later readings. However, as an example, suppose that the full price of a callable bond is 101.060489 per 100 of par value. The option pricing model input includes the length of call protection period, the schedule of call prices and call dates, an assumption about credit spread over benchmark yield, an assumption about future interest rate volatility, and the level of market interest rates. The analyst then holds the first four input constant and raises the lower and fifth inputs. Suppose that the government par curve is raised lower than the curve. Duration measures indicate the bond sensitivity to the benchmark yield curve, in particular the government par curve, assuming no change in credit spread. Okay. Although effective duration is the most appropriate interest rate risk measure for bonds with embedded options, it also is useful Exhibit 5, the quoted flat price for a bond is 99 to 16th and 3/4 and 3/4, which is equal to 99. And so the modified duration of the bond is showing Exhibit 5 to be 4.853, which is the conventional yield duration statistic. Its curve duration, however, 4.882, which is the price sensitivity with respect to changes in the U.S. Treasury par curve on Bloomberg. The effective duration is called the OAS duration because it is based on the option pricing model that is also used to calculate the option adjusted spread. The small difference arises because the government yield curve is not flat. When the par curve is shifted in the model, the government spot curve is also shifted, although not in the same parallel manner. Therefore, the change in the bond price is not exactly the same as it would be if its own yield to maturity changed by the same amount as the change in the par curve. In general, the modified duration and effective duration on the traditional option-free bond are not identical. The difference narrows when the yield curve is flatter, the time to maturity is shorter, and the bond is priced closer to the par value. The modified duration and effective duration on an option-free bond are identical only in the rare circumstance of an absolutely flat yield curve. Key rate durations. Key rate duration provides further insight into a bond's sensitivities to changes in benchmark yield curves. A key rate duration or partial duration is a measure of a bond's sensitivity to change in the benchmark yield curve as a specific maturity segment. In contrast to effective durations, key rate durations help identify shaping risk for a bond. That is a bond's sensitivity to changes in the shape of the benchmark yield curve. The previous illustrations of effective duration assumed a parallel shift of 25 bps at all maturities. However, an analyst may want to know how the price of callable bonds is expected to change if benchmark rates are at short maturities, shifted up by 25 bps by longer maturity benchmark rates remained unchanged. This scenario would represent a flattening of the yield curve. Given the yield curve is upward sloping, using key rate durations, the expected price change would be approximately equal to minus the key rate duration for the short maturity segment times the 0.025 interest rate shift at the segment. Of course, the parallel shifts in the benchmark yield curve. Key rate durations will indicate the same interest rate sensitivity as effective duration. Properties of bond duration. So these are the properties. Okay. Callable bonds require the use of effective duration because Macaulay and modified yield duration statistics are not relevant. The yield to maturity for callable bonds is not well defined because future cash flows are uncertain. Exhibit 8 illustrates the impact of the change in the benchmark yield curve, the delta curve, on the price of a callable bond price compared with that compared to a non-callable bond. The two bonds have the same credit risk, coupon risk, payment frequency, and time to maturity. The vertical axis is the bond price. The horizontal axis is the particular benchmark yield. For instance, a point on the par curve for government bonds. As shown in Exhibit 8, the price of a non-callable bond is always greater than that of a callable bond. With otherwise identical features, the difference in the value of the embedded call option. Recall that the call option is an option to the issuer and not to the holder of the bond. When interest rates are high compared to when coupon rates, compare with the coupon rates, the value of the call option is low. When rates are low, the value of the call option is much greater because the issuer is more likely to exercise the option to refinance the debt at a lower cost of funds. The investor bears the call risk because if the bond is callable, the investor must reinvest the proceeds at a lower interest rate. Exhibit 8 shows the input for calculating the effective duration of callable bonds. The entire benchmark curve is raised at a lower and lowered by the same amount, a delta curve. The key point is that when benchmark yields are high, the effective duration of a callable and non-callable bonds are very similar. Although the exhibit does not illustrate it, the slope of the line tangent to the price yield curve are about the same. in such a situation, but when interest rates are low, the effective duration of callable bonds is lower than that of the otherwise comparable non-callable bonds. That is because the non-callable bond price does not increase as much when benchmark yields fall. The slope of the land line tangent to the price yield curve would be flatter. The presence of the call option limits price appreciation. Therefore, an embedded call option reduces the effective duration of the bond, especially when interest rates are falling and the bond is more likely to be called. The lower effective duration can also be interpreted as the shorter expected life. The weighted average of time to receipt of cash flow is reduced. Exhibit 9 considers another embedded option, a put option. Okay. This looks remarkably similar to a demand curve in microeconomics, or aggregate demand in macro. Duration of a bond portfolio similar to equities. Bonds are typically held in a portfolio. There are two ways to calculate the duration of a bond portfolio: the weighted average of the time receipts of the aggregate cash flow, and two, the weighted average of the individual bond duration that comprise the portfolio. The first method is the theoretical correct approach, but it is difficult to use in practice. The second method is commonly used by fixed income portfolio managers, but it has its own limitations. The difference in these two methods to compute portfolio durations can be examined with the numerical example. Suppose an investor holds the following portfolio with 2 zero-coupon bonds. The price of par per 100 of par value, the yield to maturity are effective annual rates. The total market value of the portfolio is such an amount. The portfolio is evenly weighted in terms of the market value between the two bonds. Okay. In practice, the second approach to portfolio duration is commonly used. The Macaulay modified duration for the portfolios are calculated as the weighted average of the statistics in the two individual bonds. The shares of overall portfolio market values are the weights. The weighted average is an approximation of the theoretically correct portfolio duration, which is obtained using the first approach. This approximation becomes more accurate when the differences in the yield to maturity on the bonds in the portfolios are similar. When the yield to curve is flat, the two approaches produces the same portfolio duration. Given the equal 50-50 weights in a simple numerical example, this version of portfolio duration is easily computed. Average Macaulay duration is such a calculation. Average modified duration is such a calculation. The main advantage of the second approach is that it's easily used as a measure of interest rate risk. For instance, if the yield to maturity on a bond in the portfolio increases by 100 bps, the estimated drop in the portfolio value is 14.37%. However, this advantage also indicates a limitation. This measure of portfolio duration implicitly assumes a parallel shift in the yield curve. A parallel yield curve shift implies that all rates change by the same amount as the same direction. In reality, interest rates change frequently result from steeper and flatter yield curves. Yield volatility is discussed later in this reading. Money duration of a bond and the price value of a basis point. Modified duration is the measure of the percentage price change of a bond given a change in its yield to maturity. A related statistic is money duration. The money duration of a bond is a measure of the price change in units of the currency in which the bond is denominated. The money duration can be stated per 100 of par value, or in terms of an actual position size of the bond of the portfolio. In the U.S., money duration is commonly called the dollar duration. The money duration, or the money dur, is calculated by the annual modified duration times the full price. So that's the equation. The estimated change in the bond price in currency unit is calculated using equation 11, which is very similar to equation 7. The difference is that for a given change in the annual yield to maturity, the delta yield, the modified duration, estimates the percentage price change in money duration estimate and changes in currency units. So that's the equation. For an example of money duration, consider 6% semi-annual coupon payments. Coupon payment bonds that matures on 14th of February. Oh, Valentine's Day, 2022, and it's priced at a 6% for a settlement on April of 2014. The full price of the bond is that much of per 100 par value, and the annual modified duration is 6.1268. Suppose a Hong Kong-based life insurance company has a position on a bond of par value Hong Kong dollars 100 million. I mean, that's not a lot. And the market value of the investment is Hong Kong dollar. That amount, the amount of the money duration of Hong Kong dollars is using the formula. You will get the PV full and the money duration. Okay. The price value of a basis point, the PVBP basis point for a bond is calculated using this equation. Okay, quite straightforward. Bond convexity, modified duration, measures the primary effects of bond's percentage price change given a change in the yield to maturity. A secondary effect is measured by the convexity statistic, which is illustrated in Exhibit 10. For a traditional option-free fixed-rate bond, the true relationship between the bond price and the yield to maturity is that curved convex line shown in Exhibit 10. This curved line shows the actual bond price given its market discount rate. Duration estimates the change in the bond price along the straight line that is tangent to the curved line. For a small yield to maturity changes, there is little difference between the lines, but for larger changes, the difference becomes significant. The convexity statistic for the bond is used to improve the estimates of percentage price change provided the modified duration alone. Example, equation 13 is the convexity adjusted estimate of the percentage change in the bond's full price. The first bracket expresses the first order effect, and the same is the same equation as equation 6. The annual modified duration, or the mod dur, is multiplied by the change in the annual yield to maturity, or delta yield. The second bracket expression, the second order effect, is the convexity adjustment. The convexity adjustment is the annual convexity statistic, the AN convexity, times 1/2 multiplied by the change in the yield to maturity squared. The additional return is a positive amount on the traditional option-free fixed-rate bond for either an increase or decrease in the yield. In Exhibit 10, the amount adds to a linear estimate provided by the duration alone, which brings the adjusted estimate very close to the actual price on the curved line, but is still an estimate. So the squiggly equal sign is still the more or less equal to sign. Is also applies right here. They're using the Bloomberg Business Terminal. I don't know how many people use this. I mean, I use this. It's quite a useful piece of technology. Pretty sure everybody in the finance world has at least used it once. Okay. The two bonds in Exhibit 12 are assumed to have the same price, yield to maturity, and modified duration. Therefore, they share the same line tangent. In the price yield curves, the benefit of greater convexity occurs when the yield to maturity changes. For the same for the same decrease in yield to maturity, the more convex bond appreciates more in price, and for the same increase in yield to maturity, the more convex bond depreciates less in price. The conclusion is that the more convex bond outperforms the less convex bond in both bull rising prices and bear falling prices markets. This conclusion assumes, however, that the positive attribute is not priced into the bond. To the extent that it is included, the most convex bond would have a higher price. That does not diminish the value of convexity. It only suggests that the investor has to pay for it. As economists say, there is no such thing as a free lunch. In the same manner as the primary primarily the first order effect of the shift in the benchmark yield curve is measured by effective duration. The secondary or second order effect is measured by effective convexity. The effective convexity of a bond is a curve convexity statistic that measures the secondary effects of a change in the benchmark yield curve. A pricing model is used to determine the new price when the benchmark curve is shifted upwards, the PV plus, and when it's downwards, the PV minus, but the same amount, the delta curve. These changes are made holding other factors constant, for example, the credit spread. Then equation 17 is used to calculate the effective convexity, F con, given an initial price. This equation is very similar to equation 14 for approximate yield convexity. The difference is that equation 14, the denominator includes the change in the yield to maturity squared. Hence, the denominator includes the change in the benchmark yield curve squared. Negative convexity, which is being called the concavity, is an important feature of callable bonds. Puttable bonds, and on the other hand, always have positive convexity as a second order effect. Effective convexity indicates the change in the first order effect as the benchmark yield curve is changed. And in Exhibit 8, as the benchmark yield goes down, the slope of the line tangent to the curve for the non-callable bond steepens, which indicates positive convexity, but the slope of the line tangent to the callable bond flattens as the benchmark yield goes down. Technically, it reaches an inflection point, which is when the effect convexity shifts from positive to negative. Excuse me. Excuse me. In summary, when the benchmark yield is high and the value of the re-embedded call option is low, the callable and non-callable bonds experience very similar effects from interest rate changes. They both have positive convexities, but as the benchmark yield is reduced, the concurve diverges. At some point, the callable bond moves into the range of negative convexity, which indicates that the embedded call options has more value than the issuer and is more likely to be exercised. The situation limits the potential price appreciation for the bond arising from a lower interest rate, whether because of a lower benchmark yield or a lower credit spread. And this is the equation in the numerator. Okay. Makes sense. Interest rate risk and the investment horizon. This section explores the effect of yield volatility and the investment horizon, and the interaction between the investment horizon, market price risk, and coupon reinvestment risk. Fixed income assets are senior to equity. That means in the event of liquidation, fixed income or bond holders receive the money first from the liquidation before equity holders receives any of the assets and any of the liquidated portfolios. So that's just something to keep in mind when talking about the volatility and the risk of fixed income assets. Yield volatility, an important aspect to understand the interest rate risk and return characteristics of an investment in a fixed rate bond, is the time horizon. This section considers a short-term horizon. A primary concern for investors is that change in the price of a bond given a sudden change in the yield to maturity. The accrued interest does not change, so the impact of the change in the yield is on the flat price. On the bonds, Section 4.2 considers a long-term horizon. The reinvestment of coupon interest then becomes a key factor in the investor's horizon. Yield bond duration is the primary measure of credit arising from the change in the yield to maturity. Convexity is the secondary risk measure. And the discussion of the impact on the bond price, the phrase for a given changes to a yield to maturity is used repeatedly. For instance, the given change in the yield to maturity could be 1 BP or basis point, 25 BP or 100 BP. And comparing two bonds, it is assumed that a given change in the same of both securities when the government bond per curve is shifted up or down by the same amount to calculate effective duration and effective convexity. The events are described as parallel yield curve shifts, but yield curves are rarely, if ever, straight lines. The shift may also be described as a shape-preserving shift to the yield curve. The key assumption is that all the yields to maturity under consideration rise or fall by the same amount across the curve. Although the assumption of parallel shifts in the yield curve is common in fixed income analysis, is not always realistic. In reality, the shape of the yield curve changes based on factors affecting the supply and demand. Okay. However, the term structure of yield volatility may have a different shape depending on the number of factors. In term structure of yield volatility, the relationship between volatility of bond yields to maturity and the times to maturity. For example, a central bank engaging in expansionary monetary policy might cause the yield curve to steepen by reducing short-term interest rates, but the policy might cause greater volatility in short-term bond yields to maturity than in long-term bonds, resulting in a downward sloping term structure of yield volatility. Longer-term bond yields are mostly determined by future inflation and economic growth expectations. These expectations often tend to be less volatile. Yeah. Investment horizons. Section 2 includes examples of interest rate risk. Using a 10-year 8% annual coupon payment bond. The results are summarized in the following table to reveal the remarkable outcome. The total return of the horizon yield are virtually the same. The investors with a 7-year horizon, unlike those having a 4 or 10-year horizon, to achieve the same holding period rate of return, whatever interest rate is risen or rates or fall remains the same. Notice that the term horizon yield and the holding period rate of return are used interchangeably in the reading. Sometimes horizon yield refers to the yield on the bonds that need to be sold at the end of an investment holding period. The particular bond was chosen for as an example to demonstrate an important property of Marcalle's duration. For a particular assumption about the yield volatility, Marcalle's duration indicates the investment horizon for which coupons for which coupon reinvestment risk and market price risk offsets each other. In section 3.1, market's duration of a 10-year 8% annual payment bond is calculated by a 7.0029 year. This is one of the applications of the durations. The particular assumption about the yield volatility is that there is no one parallel shift in the yield curve that occurs before the next coupon payment date. Exhibit 13 illustrates the property of a bond duration, assuming that the bond is initially priced at par value. Okay. As demonstrated in panel 13, when interest rates rise, duration measures the immediate drop in value. In particular, the money duration indicates the change in price. Then as time passes, the bond price is pulled to par. The gain in the future value is reinvested. Coupon starts small but builds up as time passes. The curve indicates the additional future value of the reinvestment coupon because of higher interest rates at the same time. At the same point of the lifetime of the bond, these two effects offset each other, and the gain on reinvested capital and reinvested coupons and equal to the loss of the reinvested. The same pattern is displayed in panel 8 when the interest rate falls, which leads to a reduction in the bond yield and the coupon reinvestment rate. The earlier numerical example of Exhibit 13 allows the statement of the general relationship among interest rate risk, the mortgage duration, and the investment horizon. When the investment horizon is greater than the mortgage duration of a bond, coupon rate investment risk the investor's risk is lower than the interest rate. When the investment horizon is equal to the market's duration of a bond, coupon rate reinvestment offsets the market price risk. When reinvestment risk offsets market price risk, when the reinvestment risk horizon is less than the market's duration of the bond, market price risk determines coupon reinvestment risk. The investor's risk is to higher interest rates. The difference between the market's duration of a bond and the investment horizon is called the duration gap. The duration gap is a bond market's duration minus the investment horizon. The investor with a 10-year horizon has a negative duration gap, and the currently is at a risk lower rate. The investor with the 7-year horizon has a duration gap of 7 of 0 and currently is hedged against interest rate risk. The investor with a 4-year horizon has a positive duration gap and is currently currently is important because the interest rate risk is connected to an immediate change in a bond's yield to maturity. And the coupon reinvestment rate as time passes, the investment horizon is reduced and the market's duration of the bond also changes. Therefore, the duration of gap changes as well. Summary: this reading covers the risk and return characteristics of fixed rate bonds. The focus of it is on the widely use of measures of interest rate risk, duration, and convexity. These statistics are used extensively in fixed income analysis. The following are the main points made in the rating. The three sources of return on fixed rate bonds purchased at par value are receipts and promised coupons, and principal payments on the scheduled dates, reinvestment of coupon payments, and potential capital gains, as well as losses and the sales of the bond prior to maturity. For a bond purchased at a discount or a premium, the rate of return also includes the effects of the bond price, the pull to par as maturity nears, assuming no defaults. The total return is the future value of reinvested coupon interest payments and the sales of price. Coupon reinvestment risk increases when the higher coupon rate and the lower reinvestment time period. Capital gains and losses are measured from the carrying value of the bond and not from the purchase price. The carrying value includes the amortization of discounted or premium if the bond is purchased at price below the or above the par value. The carrying value is any value on the constant yield price trajectory. Interest income on the bond is the return associated with the passage of time. Capital gains and losses are the returns associated with the change in the value of a bond as indicated by the change in the yield to maturity. The two types of interest rate risk are fixed rate bonds and coupon reinvestment. Risk and market price risk. The risk offsets each other to a certain extent. An investor gains from higher rates and on reinvested coupons, but loses from a bond when it is sold at a capital loss because the price below the constant yield price trajectory. An investor loses from the lower rate on reinvested coupons, but gains in the bond is sold at a capital gains because the price is above the constant yield price trajectory. Okay, so this is reading 54. I hope to see you guys next time in reading 55. Okay, goodbye.